Cipher Mining, ticker symbol CIFR, just got slammed again on Thursday, closing the session at $14.93, down $2.45, or just over 14%. This is now the second heavy day in a row for the stock, and it's happening against the backdrop of a market that is clearly struggling, especially in the tech and high-growth sectors. The big question today is what exactly caused this kind of sell-off, whether there's something deeper going on with the company itself, and what investors should be thinking about heading into Friday and the weekend. To understand the move, we need to remember the context. Cipher Mining has been riding one of the strongest narratives in the mid-cap space over the past few weeks. Earlier this month, the stock surged to fresh all-time highs after the announcement of a $5.5 billion, 15-year lease agreement with Amazon Web Services. This deal positioned Cipher not merely as a Bitcoin miner with some AI ambitions, but as a genuinely emerging player in the artificial intelligence infrastructure space. It was a huge moment for the company, and the stock reacted accordingly. It ran from the mid-teens into the mid-20s in a matter of days. But here's the other side of that story. When a stock runs that hot, that fast, it becomes incredibly sensitive to any shift in market mood. And right now, the market mood is rough. Tech stocks were hammered again today. Inflation fears remain in focus. Interest rates remain high. Talk of escalating trade tensions is putting pressure on everything in the growth category. When the macro environment turns this hostile, the stocks that got the most love on the way up are usually the ones that get hit the hardest on the way back down. Cipher is very much in that category. But there is more happening under the surface than just weak market sentiment. Cipher recently priced a massive $1.4 billion senior secured notes offering. This financing is meant to fund construction of its Barber Lake facility in Texas, which is central to its AI hosting capacity and tied directly to the AWS contract. The notes carry an interest rate of about 7.1% and mature in 2030. While this financing is necessary, the size of it has been a sticking point for some investors. In an environment where borrowing costs are already high and risk-off sentiment is rising, taking on more debt, even if strategic, makes the stock more vulnerable. This doesn't mean the company made the wrong move. In fact, if Cipher wants to scale into a true AI infrastructure leader, it absolutely needs access to significant capital. Data center buildouts are extremely expensive, and demand for power, cooling, and land is exploding faster than supply. The AWS deal requires huge upfront investment before the long-term revenue begins to flow. But what it does mean is that the market now expects perfect execution. Cipher has shifted into a phase where it is no longer being priced based on potential alone. It's being priced based on its ability to deliver a multi-billion-dollar infrastructure roadmap smoothly, on time, and without cost overruns. That shift in expectations is important to understand. Earlier, investors were willing to buy the hype. The idea of a Bitcoin miner pivoting into AI infrastructure seemed innovative and daring. Now investors want proof. They want construction updates. They want timeline visibility. They want clarity around cash flow. They want assurances about how the company will service its new debt. They want to see that the AWS deal is not just a headline but a fully operational, revenue-producing partnership. On top of all that, you have the psychological effect of recent price action. The stock soared to $25. Traders locked in profits. Short-term speculators who got in for the hype cycle are now exiting. Momentum traders who rode the run-up have flipped their scripts and are now selling into weakness. When a stock breaks technical levels as quickly as Cipher has the past 2 days, the selling can intensify rapidly. Price often moves faster on the way down than it did on the way up. There's also the timing factor. Cipher is in the middle of investor and conference appearances, including the Cantor Crypto and AI Infrastructure Conference and the JP Morgan US Opportunities Forum. These events matter because they finally give analysts, institutions, and professional investors the chance to ask tough questions. When a stock has run as hard as Cipher has, institutional investors will push management harder. They want details about the ramp-up. They want to understand the power purchase agreements. They want clarity on how the company will manage operational risks. The company may very well answer those questions positively, but until those answers arrive, some investors prefer to step aside. Another dynamic to consider is the delay in revenue from the AWS contract. While the deal itself is huge, the actual lease payments don't begin until August 2026. That is still nearly 2 years away. In a strong bullish market, distant catalysts are exciting. In a weak macro environment, distant catalysts are a liability. Investors suddenly want nearer-term revenue, nearer-term clarity, nearer-term proof that the pivot is real and working. Despite all this, the long-term thesis for Cipher hasn't changed. The AI infrastructure bottleneck is real. Hyperscalers like Amazon, Microsoft, and Google are investing tens of billions into data center expansions. The world simply does not have enough power, land, or cooling to meet the needs of the next generation of artificial intelligence models. Companies with access to power-dense regions, and Cipher is very much one of them, hold structural advantages that cannot be replicated quickly. Cipher already operates in Texas, one of the most energy-rich regions in the United States. It has experience with high-density power operations from its mining background. It has secured major partnerships with AWS, Google, and FluidStack. It is not starting from zero. The real challenge now is execution. Can Cipher turn ambitious plans into functioning, revenue-producing infrastructure? Can it manage large amounts of new debt responsibly? Can it build on schedule and scale safely without blowing out costs? Can it keep earning the trust of institutional partners? In many ways, this is a classic valley of execution moment. The hype cycle is over. The real work begins. So what would make for a compelling Thursday after-hours video angle? The most powerful frame is this: Cipher Mining just entered the proving ground. After 2 brutal days of selling, the company now has a choice to make. Will it show investors it can deliver on the AI infrastructure promise, or will the weight of its debt, its timelines, and the macro environment drag the stock lower before the next leg up? This narrative works because it gives viewers both sides, the massive potential and the real-world pressure. It acknowledges the drop without abandoning the long-term story. And it is honest about the fact that stocks transitioning from early-stage excitement to major infrastructure execution always hit turbulence. A great angle is something like, CIFR plunges 14%, but is this the shakeout before the real move? Here's what the market is missing. You can then explore how the AWS deal, the long build-out timelines, and the macro environment clash in the short term but could create opportunity for long-term believers. You can also position it as a moment where the hype is gone and the hard truth begins. Investors love that framing. It's dramatic but still grounded. For your audience specifically, you can lean into your strength, offering a calm, measured assessment, acknowledging the risks, highlighting the execution milestones, and laying out the case for why Cipher may be undergoing a reset rather than a collapse. Cipher Mining's AI pivot is still intact. But the market is saying one thing very clearly: you've told us what you're going to build, now show us you can build it. That is the story worth telling tonight.